Breaking news, it's just been discovered some of the biggest Wall Street banks are betting on a possible economic crisis.
I'm going to explain exactly what the AI news report was talking about in one simple fast step. Step number one, let's go over what exactly, or WTF, whichever you prefer, is going on right now. And I want to point out before we move forward that banks haven't done this since 2008. What am I talking about specifically? Let's look at a chart, today's date going all the way back to 2006. On the left, we go from 400 billion up to 1.2 trillion. Now, this chart represents the collateral that broker-dealer banks are holding on to right now. And I'm going to explain that more in just a moment. But the main takeaway here is during the GFC, in fact, Q1 of 2008 to be specific, the amount of collateral, pristine collateral they were holding on their balance sheet was right around a trillion, maybe 1.1. And we fast forward to today, where we're definitely in the no bueno zone, that's for sure. Why? Because the amount of collateral these broker-dealers are keeping on their balance sheet just exceeded the levels we saw in Q1 of 2008, the global financial crisis. So why would these insiders make a $1 trillion Michael Burry bet? We're going to go over that in just a moment, but before we do, let's go right to the internet and go over the details as to exactly what they're doing. This intel is straight from creditbubblebulletin.blogspot.com. I want to make sure we give credit where credit is due. And they highlight the fact broker-dealer debt securities holdings surged 145 billion last quarter, or 56% annualized. And this is surpassing Q1 2008's 1.1 trillion to a record $1.17 trillion. Now, I know a lot of you right about now are saying, okay, George, well, what are debt securities? Debt securities are usually things like mortgage-backed securities and treasuries. So these assets are the collateral that's used in the monetary system. So we say, okay, well, why are they loading up on all this collateral? We're going to get to that in a moment on the whiteboard. But before we do, let's ask the question, how are they financing this? And a lot of it is being financed in the infamous, let's say, repo market. Right here, they point out repo liabilities ballooned 361 billion, or 61.8% annualized during the last quarter, up to $2.697 trillion, the highest since Q3 of 2008. Not exactly the best time for financial markets, the U.S. economy, or the global monetary system, to say the least. So why are these broker-dealers choosing to hold more and more collateral on their balance sheet to a point now where it's higher than it was in 2008? Well, to understand this, we have to figure out what these broker-dealers actually do. And to give you a little bit of a visual, they're kind of like a payday loan place where there's no way you would ever go to a payday loan place because you know they're going to charge you like 150,000% interest or whatever it is. So you only go there when things are bad and you're absolutely desperate. Well, in a way, this is what the broker-dealers are doing in time of crisis. In fact, let's use our AI editor so you guys can get a better idea as to how they actually operate.
I'm a financial institution, and I need to borrow collateral ASAP.
No problem, Mr. Financial Institution. We just happen to have the collateral you need. Our fee is 150,000%.
So there's three main reasons they do this. Number one, to pocket a spread when the stuff hits the fan. So just like that payday loan guy, you go there when you're absolutely desperate. It's the same thing with financial institutions. If they don't have any liquidity, then a lot of times they have to have collateral. And if they don't have anything on their balance sheet that's acceptable, they go to the payday loan place of the financial system and say, yeah, sure, I'll pay your 150,000% interest. So by lending out the collateral that everyone in the financial system needs, but they don't have, they're going to be able to charge a very high price. The next reason is because they might see economic storm clouds coming and they just want to de-risk their own balance sheet. And third, what happens if the stuff hits the fan? Most likely interest rates drop. Well, if they're holding treasuries or mortgage-backed securities on their balance sheet that they bought when they were trading at, let's say, 4%, and interest rates go down to 2%, and this is just a hypothetical, then they're going to have capital appreciation on those assets, those bonds they have on their balance sheet. Whoa, time out. I want to make sure everyone's on the same page here. So editor, let's go ahead and cut to a clip from a recent interview I did with my good buddy, Jeff Snyder, who is the foremost expert on financial plumbing and the monetary system.
When dealers are holding more treasuries, either number one, they're just buying treasuries just to hold them on their balance sheet, something safe and liquid that can give them a dependable return, where we don't have to worry about credit risk. Or in the realm of collateral, they're holding it because either they think they're going to need it for their own operations, or as dealers, they'll be able to take advantage of everyone else who out there will be short of collateral, and therefore they can charge higher prices to rent that collateral out. It could be a directional bet too. They could be saying, okay, whether or not we're risk averse, it doesn't matter. What we see is that the economic circumstances, the financial circumstances too, are less than ideal. And therefore we're going to buy treasuries because as these fears that we have about the economic circumstances become realized, everybody will pile into treasuries. So we want to get there first because we're making a bet on treasury prices going up, regardless of interest rates. So any way you slice it, it comes back to the same thing, which is we're taking advantage of something that leads to treasury prices going up. Therefore, the demand of safety or the demand of safe collateral going up. And those tend not to be good outcomes.
The main takeaway from this video is these Wall Street insiders are putting on a $1.1 trillion bet. And by the way, if you look at the trend line here, it could go a lot higher in the very near future, that we're going to see a risk-off event. This is the key. Now, is the risk-off event that they are preparing for a garden variety recession? Maybe just an economic slowdown in the United States, or maybe just an economic slowdown in the global economy? Or is it a financial crisis or a collapse? I have no idea. This is not my prediction. It may or may not be. What I'm doing here is I'm simply explaining to you and revealing what's happening in the financial system, because this is very relevant information that you should include in your overall analysis. And if you want more intel just like this, that'll not only help you survive, but actually build wealth and thrive in this crazy world of out-of-control central banks and big governments, you can check out my free weekly newsletter. There's a link in the description below.